Welcome to the very first edition, as I turn up my mic here, to Mining Metrics. My name is Jarrett, and I run media at Compass Mining. If you're joining us on LinkedIn, X, or YouTube, thank you for being here. This is the first edition of many to come. We are going to be launching this. Well, we're launching this on the third Wednesday of November, and we will be doing this the third Wednesday of every month moving forward, especially as we get into the bull. If you're in Bitcoin or you're in Bitcoin mining, this is a very exciting time to be around this. I'm joined today, and this is a co-collaboration between Compass Mining and Luxor. I'm joined today by Kaan from Luxor, and I'm going to pass Kaan the mic. Kaan, how are you doing?
Thanks so much, Jarrett. Doing well. Looking forward to this. I think it's going to be a super fun session.
I think it's going to be great as well. The idea here was Compass and Luxor came together. We're both in the Bitcoin mining space, and it was like, what can we do to create some media to bring more people in? Not only people who are already in the industry, but anyone who's maybe peripherally on the industry, thinking about either working with either of our brands from a partnership level or just from retail level. And we're like, how can we make the right amount of signal in a world of noise? Because that's the world we live in on the internet. And so what we've done is we've created this show. This show will be just a monthly show, at least for now, and maybe they'll be pushed to do more. But right now, a monthly show to really go over, as the name of the show is called, the mining metrics. So things that have to do with mining. One of the things I think we're going to kind of stay away from is we're probably going to stay away from overall pubco price. There are a bunch of other shows that are out there doing that. I'll call one out because we are the title sponsor. Power Mining Analysis, which is run by Bryce McNally and Anthony Power, one of the best shows on the internet right now that really looks at all of the publicly traded mining stocks and what those companies are doing to grow their businesses, their individual and prospective businesses. We wanted to look at other things. Now, this may be some nerdy mining stuff, but that is what I think we're both really excited to talk about. So what we've done here is we've created, and when I say we, I mean Kaan and the great people at Luxor have really put together all of their analytics, their metrics to come together with a presentation. So most of this show is going to be driven around data. This is going to be a data-driven show as opposed to Kaan and I just getting up here and sharing our opinions, which maybe you would like to hear as well. But what we're going to do is share a presentation, go through that, leave 10 to 15 minutes on the end for questions. But also, because this is a live show, feel free to ask questions at any time. You can do that if you're on LinkedIn by just putting in a comment into the live underneath the live, and it will populate on our end. I also have one of my colleagues, Chris L, who's probably watching this. Chris L, as you see stuff, you can feel free to go ahead and send me that message if you see something that pops up on X and YouTube, because I just may not be able to watch it as I'm live. So without further ado, let's get going. Kaan, if you'd please go ahead and share your screen, unless there's other stuff you think we need to say before we get in, because once we put up the presentation, people are going to be dialed in on that. Anything else you think we need to share before we dive right into the mining metrics?
Let's get started. Let's do it.
Let's do it.
All right.
All right. So I'm now going to go ahead and share this. Just for everyone's knowledge, at the end of this, we will take this down and we will put this up on YouTube so that way you can go access this, so you can see this information. I think one of the great things about metrics and kind of documenting live metrics as we're going through them, as we're living through them, is being able to look back. Because if you're in mining, you're going to look back at this in probably 6 months, 12 months and think, oh my gosh, I remember those days. I remember that hash price. I remember when those ASIC prices, right, for the latest Bitmain equipment, etc. So hopefully this is just a snapshot today of where we are in the industry. And as you know, if you're in the industry, it feels like we're at a precipice of absolute crazy growth. So I'm going to pass the mic, stop talking as much, and Kaan, please dive in.
Thanks, Jarrett. Let's get started with November 2024. So our agenda for today, we'll start off with a TLDR, give a very quick executive summary. Then we'll go into mining economics, talk about hash price and its component factors. We'll then take a look at the hardware side of the market, take a look at some ASICs. We'll transition into public markets, take a look at some pubco activity, and then finish off with a section on hash rate derivatives. So TLDR, Bitcoin miners are facing a challenging hash price environment, but the tide may be turning. October 2024 boosted hash price, and November is only adding fuel to this fire. ASICs are reacting to changes in mining economics, which we'll take a look at. Pubcos are hodling. Forward markets matter. Hedging early tends to earn more than spot. And forward markets will also give us some insight into future looking expectations. What we're seeing right now is that Bitcoin price and global network hash rate is expected to increase. So let's start off with mining economics. And really, the major metric to look into for this is hash price. Hash price is a term coined by Luxor, and essentially it gives us a way to measure the revenue that a certain amount of computational power, i.e., hash rate, can generate for a Bitcoin miner. So far, this month, there's been an uptick in optimism, but the past few months have been quite challenging for Bitcoin miners. August and September printed the two lowest average monthly hash rate prints that we've seen since 2017. And this was around $43 per petahash per second per day. Now, as we all know, October tends to be an exciting month. October 2024 proved this to be the case. Hash price rebounded by around 11%. We saw an average monthly hash price of around $47. But zooming out and looking at the bigger picture, again, this is actually the third lowest record on print since 2017. Every component factor of hash price, which is Bitcoin price, network difficulty, and transaction fees, was up during the month of October. Although this is good from a Bitcoin price and transaction fees perspective for Bitcoin mining participants, it's also negative when it comes to global hash rate and network difficulty, because what this means is that Bitcoin mining has never been as competitive as it is right now. So what are we seeing in November? So far, average hash price is around $52. Bitcoin price is ripping, as we all know, and network difficulty continues to climb, and transaction fees are volatile. So what's happening in November? Well, in a nutshell, this is what we're seeing, a big uptick. What this chart shows is Bitcoin price versus Donald Trump's election odds on Polymarket throughout the last week of the US presidential elections campaign. We can see a quite close positive association between the two, which means that the election of Donald Trump clearly had a role to play in Bitcoin's price action that we've seen recently, but this doesn't mean that it's the main driver. There's been a lot of tailwinds that have accumulated throughout the year of 2024, most notably massive increase in institutional adoption via ETFs and the financialization of Bitcoin as a financial instrument. And now what we're seeing is an embrace and acceptance from the political perspective, and perhaps a more regulatory certainty as we move into the next mining cycle as well.
If I could, I wanted to add a comment on this. The poly market, for those that aren't maybe up on it, is a very fascinating thing. And I think in the next election cycle, poly markets and maybe apps like Kalshi, where you can basically put your own money and say, I think this candidate's going to win, are probably going to be taken a lot more seriously, because both Polymarket and Kalshi were way ahead of some of the other more mainstream media polls. So that is just an interesting tidbit to call out, that I think moving forward, some of these more, I want to say decentralized, even though I know they're centralized places where people voting are voting, but places where anyone can vote and not just people that are stateside, is a very, very interesting thing. And so, yes, we're talking about price here, but I think, and as we said actually last night on an X space that we're running called Talk Mining Tuesdays, the overall sentiment with the Trump win is bullish for Bitcoin, and especially the Bitcoin mining industry. So just calling that out.
Absolutely. Okay, so now that we've talked about Bitcoin price, which is one major component of hash price, let's take a look at the other constituents. The first thing is network difficulty. Network difficulty continues to set record highs. The latest downward adjustment we've seen was in late September, which was around 5%, but difficulty has been climbing up ever since. One factor for us to consider here is seasonality. As the seasons shift from summer towards fall and winter, we see that participation in demand response programs, for example, the four coincidental peaks in Texas, tends to calm down. So miners stay online and they're hashing, uptime increases, which means that difficulty will also react to this and adjust upwards as a response. Now, the past four adjustments have been upwards, with the latest being a very slight increase, just over 0.5%. Of course, this is driven by hash rate growth. Our 30-day simple moving average global network hash rate is currently at around 740 exahash per second, which is up by 9% from the previous read 30 days ago. Now, the main message with transaction fees is that they tend to come and go. The summer of 2024 was marked by minimal fees, but what we've seen in the past few days is that block space demand is beginning to heat up a little bit. In October, we observed occasional bursts of what are known as non-standard transactions. So this involves activity around ordinals, inscriptions, rune mints, etc., which led to intermittent spikes in transaction fees, which we can see in this chart here. And sometimes these would essentially triple average fees collected per block throughout a day. Despite this, though, if we zoom out and look at the big picture, average transaction fees collected per block per day in October were 0.15 Bitcoin. And the lifetime average of Bitcoin's transaction fees is actually 0.34. So October saw less than half in transaction fees being collected. And this also comprised around 4.5% of the overall block reward. So far in November, what we're seeing is that average transaction fees collected per block per day is around 0.096 Bitcoin, so even lower than October. And fees right now constitute just under 3% of the overall block reward. So an observation for us to consider here is that as we zoom out and look at the big picture, transaction fees are still a minimal proportion of the overall revenue for miners, which means that revenue for miners tends to be mostly sensitive toward the subsidy, but this dynamic will eventually evolve as fees become a larger proportion as we move through progressive halving cycles.
I was interested by that specifically because you're saying the summer of 2024 was maybe lower for transaction fees
Mhm.
typically than historical amounts, and you just said October was pretty low as well. But it's interesting because in the spring, obviously there was the halving, and then right after the spring, it like spiked. Where I'm assuming that it was not just 5% of the overall reward given to the miner, but maybe 20%, if not higher, because those grew so much. Do you think, and this is maybe outside of mining, but more Bitcoin culture here, do you think we're going to see another spike with maybe not the rise or the return of the Jedi or the return of the ordinal, but like, do you think ordinals and runes are going to come back and be vying for block space to a point where the transaction fees may increase again? And is that also tied to maybe a certain Bitcoin price that you see?
It's an interesting question. There's definitely a cultural aspect, especially when it comes to the halving, which took place in 2024. As we know, the first block right after the halving was an incredible block. It had a ton of Bitcoin in there, posted as fees for transactions. What we're seeing is that our transaction fee forecast models are becoming relatively more bullish nowadays. And what that can be driven by is essentially any demand for block space. So whether that's financial transactions due to increased on-chain activity or non-standard transactions such as mints, meta protocols, the cultural aspects beyond Bitcoin and developments on the software side, we don't necessarily know what they're being driven by, but what we're seeing is that our forecasts are increasing. So we do expect block space demand to be relatively higher nowadays versus the summer.
Great, great.
Awesome. Now let's get into the hardware side of the market. Let's talk a little bit about ASICs. So the first thing we see here is our hash cost table. This is a very interesting table that we like to put together, and it gives us a matrix formed along two dimensions. The first thing we're looking at the very top row is our power costs, denominated in both US and Canadian dollars, i.e. cents per kilowatt hour. And the second dimension that we can see with the column going downwards is our efficiency, denominated in joules per terahash. Now, what this matrix is telling us is essentially based on a specific hash price level, to what extent we can afford to incur expenses in terms of electricity as an operating expense before we either turn unprofitable or we remain profitable. So this chart is telling us at what level it would make sense for us to shut down as a Bitcoin miner and to stop hashing, or end up paying to mine, versus when we get paid to mine, when we're generating revenue, because the revenue we generate based on mining economics is higher than the cost we incur in terms of operating a machine with a certain level of power costs. Now, what I have here is a $60 hash price. This is currently what we're seeing. I think this morning hash price was around $61. Yesterday it was around 60. And for example, let's take a look at 38 joules per terahash. Essentially what this chart is saying is if I have a machine running at 38 joules, at most I can afford a power cost of around 6 US cents per kilowatt hour. Anything beyond that, I'm in the red. I'm unprofitable. I need to shut my machine down. It doesn't make sense for me to mine if I'm looking to make money, because I'm essentially paying to mine. My costs are above the revenue generated based on where hash price is at right now. And we can follow the same logic for a range of power costs and a range of efficiencies. What we can see is the more efficient my machine is, the more breathing room I have in terms of the power cost I can incur, and vice versa. The cheaper my power cost is, the less efficient of a machine I can afford to run.
Can I ask a question about this? And I also just want to say, from a mining perspective, whether you're in the industry or you're coming into the industry and you're trying to wrap your head around, okay, this is what an ASIC does. How, which ASIC is better than another ASIC, right? You want to be able to compare apples to apples. And I think obviously, yes, the joules to terahash and then understanding the electricity. I just think this is one of the greatest graphics I've ever seen in Bitcoin mining. And so hats off to you guys for putting this together and sharing this, because I just think this is such an easy way for people to be able to kind of figure it out. It looks like a BMI chart, body mass index chart. If you ever looked at that, you find your age and your height, and then you're like, how out of a shape am I, right? Well, now you're finding your electricity, and you're finding your joules per terahash, and then you're saying, okay, am I profitable? And this is this pretty simple binary thing, right? I either am or I'm not. And so I just want to call that out. I think that this is a wonderful image, and this is kind of the reason why this image alone is the reason why we're doing this, right? We want to be able to share this information. And snapshot in my head that right now it's $60, right? That hash price is $60. We're going to get into where it could go a little bit, maybe. But knowing that it's $60 today and all of these are in play at 6 cents electricity, I think that that's a pretty great thing. And I know that I think you have a SJ, an S19J Pro or something right there, and maybe it's not in screen, but yeah. Anyways, continue.
Absolutely. And we're going to get right into what this means for the individual miner as well when it comes to the ASIC purchase decision, what really matters. So let's take a look at that in the next few slides. Now, what I'm doing here is, in the previous slide, we held hash price static, but now I'm varying hash price to see what the consequences is. What does it mean when mining economics changes when it comes to our ASIC purchase decision? What we can see here is, if you look at the top left, hash price is moving from, so we're at $20. We start with 150, and then we go down to 100. Then we go down to 50, which is below where we're at right now at 60. And then we go down to 20. So the main message here is, as mining economics changes based on hash price, the cost curve is moving. We have more or less breathing room to remain profitable based on where we stand in this matrix, which is a combination of our machine's efficiency and the power cost we incur. So what this means is, as mining economics gets depressed, as hash price goes down, the green space in this matrix reduces. we have less room to breathe in terms of remaining profitable. And the outcome of this is that ASICs and demand for ASICs is highly sensitive to mining economics, specifically hash price. So it's not always the fact that just because a mining computer is the latest and greatest, the most efficient and the strongest in terms of hash rate, that it's actually the optimal decision to make. Rather, the way we have to think about ASIC purchase decisions is I need to get the right computer at the right time at the right price. So let's take a look at that right now. What are we seeing these days? What's popular? What's selling in terms of ASICs? This is data that we've collected from our ASIC trading desk, and it shows buy-side demand for October of 2024. The first observation is 4 models stand out, and the second is one of them is from the newest generation of ASICs, the S21 series, i.e. the S21 Pro, and the 3 other models we see is from an older generation, the S19 series, specifically the XP, the J Pro, and the 19 Pro. Why is this the case? Why is it that S19s are very hot right now? There's a lot of demand for them. And the answer lies in what's known as return on invested capital. It's payback, which is what matters. This is the main metric to look out for. So what we've seen in our hash cost table is that as hash price moves around, the profitability profile for a wide range of efficiencies is also changing. So I did a very simple calculation here. I assumed a $60 hash price, which is where we're at, a power cost of 7.5 cents per kilowatt hour, and 100% uptime just to keep things simple. Based off of the initial purchase price for a machine, you can calculate how long it will take for you to recoup the initial capital expenditure that you spent buying that machine, which means that after this point, you're in the green, you're making money, you're generating profit. And what we see here is that the 21 series machines, for example, the XP and the 21 Pro, has a payback period of close to 2 years, whereas the 19 series is much lower. It's around 1 year. Specifically, the XP has the lowest at just over 1 year. And taking a look at the table on the top right, again, a clear picture that we're seeing is, yes, there are machines which are more powerful in terms of hash rate and more efficient in terms of electricity being used, but that's not the right answer. The right answer depends on where mining economics is, the hash price environments, and the current price for specific machines. So again, it's about getting the right computer at the right time at the right price. Another consideration for us is the initial purchase price will have a strong determination of where your payback lies. And we'll take a look at that in the next slide. But Jarrett, I'll pause here. Do you have any questions?
Yeah, I mean, I have questions for days. And actually, I forgot to ask you a question on the last one because I'm just also, I feel like I have the front row seat to kind of look at this with you. I know that we now have almost 500 people watching, which is absolutely amazing. And it actually goes back to the previous one, but where we're showing the cost curve, and I guess here, and I know that I'd asked you this on Telegram, and this is one I want to ask. And then I do have a question about, should you buy the S19 XP or should you buy the S21 Pro? Question here is, none of us want to think about a $20 hash price. If you're in Bitcoin mining, that is like nails on a chalkboard, right? And that's where it shows right now. Then only those are in the green, right? So let's not think about that. Let me dream a little bit. And this is not financial advice, but let me dream a little bit. In order for us to get to $150 hash price, I know that you're just using that as a hypothetical, but in order for us to get to $150 hash price, and I know that we have to build on assumptions, but I'm going to put you on the spot. Where would Bitcoin price need to be able to get that hash price? Knowing today that Bitcoin's around 95,000, and I don't know, maybe it hits six figures while we're recording. I'll also dream a little, but let's assume it's 95,000 and the hash price is sitting around 60 or 61. What are you guys thinking at Luxor? What's your take on where Bitcoin price would need to be in order to, show the mining industry some love with $150 hash price?
That's a really good question and a highly relevant one. The answer is that it's not that simple. And the reason is because there are factors beyond Bitcoin price that are baked into mining economics. And this is precisely the reason why Luxor initially developed the hash price index. When we take a look at Bitcoin price and how it affects mining economics, yes, it's one factor, but there are other factors as well, specifically transaction fees and network difficulty. So the simple answer is we can't really back out a Bitcoin price unless we make specific assumptions around what network difficulty will look like and also what transaction fees will look like. Thankfully, we actually can infer information about this from our forward markets. So we're going to take a look into this later in our hash rate derivative section. But it's important to point out this nuance that Bitcoin price is not the only determinant of mining economics and hash price. There are other factors which we need to consider as well.
Absolutely, absolutely. Now, and I feel like I'm backseat driving your presentation. Can we skip ahead to where we were? Yes, perfect. So the reason why I want to call this out is I think that there's when how do I put this? When the halving happened, right? At that moment, and we're still kind of in that moment where I feel like miners are still taking the time, both retail miners who has one or two in a shed, and even the pubcos. Everyone's trying to get their hands on the latest and greatest technology. But what this is showing is that if depending on the timing, right? And this is also the snapshot of where we are right now. And we have, the $6 hash price is our assumption, 7.5 cents, per kilowatt hour with electricity costs, and 100% uptime. This is fascinating that it shows that the payback period or place where you get to you're playing with house money, right? Is a half. It's 50% less with the Antminer S19 XP as opposed to the Antminer S21 XP. And I think that excuse me, for many people, that kind of bucks what they might be thinking, where it's in the race to get the most efficient hash online. But if you're looking at it in this moment under these assumptions where we are today, it's saying, no, the XP can still hold its water. And I think that that's interesting for people to hear.
Absolutely. And just to really hammer home this point, if we go back to our static hash cost table here, what we see is the further down we go in terms of efficiency, the more of a range, the wider of a range we have in our ability to afford electricity prices. So, yes, that's one thing. It means that you're essentially future proofing yourself when you buy the latest and greatest machines, but that doesn't necessarily mean that you're going to get your payback the quickest. And that's what matters, especially for large scale enterprise grade professional mining companies, which are looking to deliver shareholder value beyond anything else. That's the real metric that matters. It's not about getting the best computer, it's about getting the right computer at the right time, at the right price. So those are the factors we need to think about when we think about purchasing ASICs.
Yeah, and I want to give a huge caveat. We're not saying please go out and sell your Antminer S21 XPs and switch them for the S19 XPs. We're not saying that at all. We're just saying in this moment, in this context, with our assumptions and where we are today, that is interesting. But as you've said, and this is totally true, I look at miners kind of like this is what I tell people. I look at miners kind of like buying an iPhone. You want to get the latest one because in 16 to 20 months, it may not be able to do as much as it can today. And you just want to stay ahead of that. And as you said, you're future proofing yourself farther out. And I don't know any Bitcoin miner that is not here for the long term, that is not, extending their time horizon. Right. So, yeah, wonderful.
Exactly. And let's continue and take a look at another aspect. We just took a look at the revenue side, but what also matters is the cost side. Like I said, your initial capital expenditure will be a determinant in your payback period. So you need to pick the right computer at the right time in terms of hash price and also at the right price. Because as we all know, ASIC prices are quite volatile. They respond to mining economics, they respond to the industry in general. They can move up and down. It's quite uncertain. So we're in a Goldilocks era where we see that hash price is improving. So mining economics is improving. We have more breathing room in terms of the cost curve. At the same time, trading prices for used ASIC machines, older generation machines, the S19 series is relatively cheap. We're nearly at an all-time low. What we can see here, if we zoom out up to a year, is over the past year, used machines have become ever cheaper in terms of dollars per terahash. as we go from the summer of 2024 into the fall, from September, October, November upwards, now we're seeing an uptick because participants in the hardware market have realized the environment has changed. Hash price is improving, machines are cheap, so it makes sense for us to buy specific machines right now. The price is right, the time is right. This is when we get in. So this is why we're seeing a significant uptick in the 19 series, specifically the XP. So the calculations are being backed by real world data and behavior in the hardware market. Both the price is right and the revenue side is right as well.
Love it. Love it.
And conversely, let's take a look at the 21 series. What we're seeing is demand is not necessarily waning. Just like you said, Jarrett, it doesn't mean that the S21 shouldn't be bought at this moment. There are reasons beyond just payback period to either purchase or to upgrade your fleet. But what we can observe is at least these prices are steady. So there isn't necessarily an uptick in demand, but there is a steady state. So the 21 series right now is remaining steady, whereas the 19 series has seen quite a significant uptick in terms of interest and demand. All right, let's now move on to public markets. Let's talk a little bit about the pubcos. The first picture here that we're looking at is some of the top publicly traded mining companies, and we're taking a look at stock price action over the past few months from October of 2024 to now. And the general picture that we see here is that there is a steady trend up and to the right. Public mining companies are doing quite well at the moment. Hash price environment has improved in health, and mining economics are a bit steady. The halving event in April of 2024 was a big challenge, and it's caused some consolidation in the industry. We've seen that M&A activity has picked up, but generally miners are doing quite well at the moment.
And Kaan, if you can stay here for a second, I want to just call out. I said this at the beginning of the stream, but we had a maybe 100 people at that point. We now almost have 600 people, and I want to just call out that we're looking at the public equities using their interest in their stocks maybe more as a signal that there's interest in the overall industry from the investor class, from Wall Street, from anyone who's got Robinhood who's interested in buying any one of the public equities, but that we're really not going to be focusing too much on what the pubcos, this isn't an in-depth on them. It's more into the other mining metrics, as the show is called. But just a shout out, if Anthony Power is watching and Bryce McNally is watching, they have Power Mining Analysis. That is a phenomenal show. You can find that. They're on X and YouTube. So I love plugging Power Mining Analysis because not only are we the title sponsor, but what they're doing to move the overall industry forward on the public side is absolutely amazing. So yeah, we won't be focusing too much, but it's interesting to see that we are up and to the right. So the attention into the industry is up and to the right.
Absolutely. And you're right, Jared. This ties back to the investor psychology and activity in traditional financial markets that we're seeing. Like I said, 2024 has had a lot of positive catalysts. Most significantly, the introduction of Bitcoin ETFs on Wall Street, which is a major milestone in the financialization of Bitcoin, and the US presidential election, and some more optimistic expectations around regulation and the legality of Bitcoin, the political perspective of Bitcoin as well. So, all this to say, generally, there's an increase in optimism around the industry as a whole, which also reflects on publicly traded companies.
Yeah, and just even yesterday, since we're sharing news, just kind of on the overall climate around Bitcoin, and then which obviously will trickle to the Bitcoin mining industry. Yesterday, options, I believe, on the BlackRock IBIT ETF were launched. So that I read earlier. I mean, we're talking a couple $1 trillion are in options every day. So if even Bitcoin and the Bitcoin ETFs get a little piece of that, it's another bullish indicator. It's another step towards, I think, global adoption and a place where hopefully when you're home with your families this holidays, people are kind of looking at you a little bit different than they were last holiday if you've been in Bitcoin and Bitcoin mining. So yeah, sorry, please on to the next.
Absolutely. And shout out to our good friends at Blockspace Media for putting this chart together, Colin Harper and William Foxley. We like to follow how Bitcoin miners tend to perform when it comes to their monthly productions. But another consideration is that at certain points in time, based on Bitcoin price action, miners can choose to make dynamic decisions around whether they sell the Bitcoin they produce or they retain it and grow their Bitcoin holdings, accumulate Bitcoin on balance sheet. And this is an observation that we're seeing right now over the past few months. Miners have generally been holding more Bitcoin than they sell. And the reason is because as Bitcoin price continues to move upwards, the spread between the effective price that a miner would pay to acquire a Bitcoin, i.e., the costs they incur in mining a Bitcoin, is widening when it comes to the spot price of Bitcoin. So this may be some sort of indication as to their expectations. Maybe going forward, they expect this spread to widen, which is why they prefer to hold right now. So we do see some dynamic decision making around Bitcoin being held versus Bitcoin being sold when it comes to some of the larger mining companies.
Con, I actually have a question, and it's not about this. I think that this is another great graphic, and definitely shout out Will Foxley. Will Foxley is a huge part of the media journey here at Compass Mining. Um, we just got a really good question from Colby about ASICs and efficiency. Do you want to answer that now because we're still kind of close to those slides, and I can bring it up on screen, or should we leave that to the end? What are your thoughts? I'm, this is our first time
Yeah,
doing this. We're kind of open to answering things in the moment, but what do you think?
let's do it. Let's go back to our ASIC section and answer this in real time.
Yeah, so Colby says, Yo, Khan, please speak on the risk factor of discounted, less efficient machines and explain the premium on top efficiency. I think we've kind of touched upon this, but I think it would be good to bring this up again. And I love that Colby's name is Colby, the Bitcoin miner plug. Colby's one of our lead sales associates at Compass, and has been he has me there on the XPs. So yeah, please feel free to dive into this.
I love that. That's an interesting question. So the risk factor of discounted, less efficient machines versus the premium on top efficiency. Now, I've had a discussion with our trading desk quite recently, and what I was told is that right now prices are very volatile. They're moving all over the place. What we're generally seeing is a repricing of ASICs across the board of efficiency tiers. So whether the risk adjusted discount or premium on these tiers changes, I think is a real time development that's taking place right now. Like I said, what we've generally seen is that the more efficient machines have been relatively steady in terms of pricing. And this could be a reflection of both demand and supply factors. At least we have insight, direct insight on the demand side. And what we're seeing is that demand isn't necessarily going up or down, it's rather steady. And I think supply is also matching that as well. Now, when it comes to the less efficient machines, we might even be seeing a premium right now based off of the analysis that we just did, right? In terms of mining economics, it's the right place, right time, right price when it comes to older machines. So there is an increased demand, a significantly increased demand for these machines. Another consideration is where you are around the world when it comes to acquiring your ASIC, because shipping costs, excise duties, import duties, tariffs, etc., are also a major factor in determining the return profile and the payback period of your ASIC miner. So this is one factor that may be blown over when it comes to running your calculations, but it's actually a highly important factor because it will have a significant influence on your payback period. So if you're buying used machines within the US and you're located in the US, it's much more advantageous for you to do that versus if you need to have it shipped across the world and you end up paying some tariffs in between, which will cause a lot of friction, and it might essentially double your payback period. So there's a lot more factors to consider, but what we're seeing is that right now there is a big repricing of ASICs.
I will take Colby's 3 flame emojis as he agrees with your analysis there, Con. So thank you. I just wanted to call that out. It seemed relevant, and Colby obviously is here with us at Compass. So, anyways, let's get back to the presentation and push forward. Colby, thank you so much for the question. If you're watching this and you have a question, go ahead and just leave that. It looks like Colby left that comment or question on X. We're also live on LinkedIn and YouTube. And if you leave comments anywhere there, they should populate here. Hopefully, we'll see them. And yeah, anyways, thank you, Colby.
Great question. Thanks, Colby. All right, moving on from dynamic decisions around holding versus selling Bitcoin for the pubcos. Before we close this section off and we transition into our last section, which is all about hash rate derivatives, here's an interesting chart. This is one thing that we like to put together at the end of every month when we get the pubcos monthly operational updates. Now, the forward market matters, and here's why. We know that most public companies don't necessarily hedge, but what if they did? What if they sold hash rate forward? What would that look like? And this is what this chart here is showing us. So the chart that we're looking at below, it illustrates a scenario of how October production for a certain set of pubcos would have differed had they fully hedged their hash rate all the way back in May, which is right before the halving that took place in April of 2024. What does this mean? It means that you would have locked in a specific hash price had you sold your hash rate forward through our derivatives contracts. In May of 2024, USD hash price was around $53. In October of 2024, spot hash price during the month was around 47. So had you fully hedged your hash rate in May, you would have earned the percentage difference between the locked in hash price, 53, versus spot 47. And what this translates to in US dollar terms is a 13% increase in your revenue. And in Bitcoin denominated terms, it's around a 14% increase in the Bitcoin that you would have ended up earning for selling your hash rate to a mining pool. It's important to keep in mind this is strictly for demonstration purposes. It makes a lot of simplifying assumptions. For example, all we're doing here is just taking the percentage difference between your two hash prices and multiplying that with your actual October production. And we're also excluding some of the friction involved in entering into these financial contracts, such as bid-ask spreads, fees, etc. So it's quite a simple demonstration just for the purposes of illustrating what hedging and selling forward can mean for a Bitcoin mining company. And then a second caveat, which is even more important, is selling forward proves to be profitable in this time frame only, in this very specific period of time. Now, it's critical to recognize that hedging and selling forward is typically a cost of business rather than a revenue generation method. The reason is because if you're engaging in hedging, you're willingly paying a price for certainty for reasons beyond generating revenue. These reasons tend to be more so around obtaining predictability in your cash flows, which can increase your valuation, reduce your cost of capital, and ultimately attract investments. So it's a consideration for large-scale enterprise professional mining companies who deal with external shareholders and have an objective of delivering value for them.
I'm glad you said that this is for demonstration purposes because the YouTuber and me came out with this is not financial advice, and I think that this is once again a snapshot, right? I'm sure that in 6 months, maybe the S21 XP is gonna blow the S19 XP out of the water, right? But for in this moment, that was the way the ASICs looked. That was the way the cookie crumbled. In this moment, this is how the hedge looks. But anyways, I'm just glad we said that. We need to say that on mic because we're just sharing the information, and also we're sharing the information looking backwards, right? Everything's easier to say in hindsight 2020.
Absolutely. Hindsight is always 2020. And like you said, Jarrett, you never know. The environment may flip to where hedging and locking in a certain hash price actually goes against you and you end up losing money versus just being fully exposed to spot. But the point here is that it doesn't matter what happens in future, because if you engage in hedging, you know what's going to happen. You're locking in a certain hash price and you're willing to pay for that certainty in an uncertain world. And that's really the main point of this message. Okay, so looking forward, hash rate derivatives, our final section here. What do forward markets look like right now? As of this morning, this is what our forward curve looks like. So what we can see here is both USD and Bitcoin denominated contracts are trading at a discount. The curves are sloping downwards, which means we're in backwardation for the foreseeable future from November till April of 2025. What this essentially means is that if you're looking to hedge for up to 6 months into the future, right now you can lock in a hash price of around $57.50 in USD terms. Compared to our current spot price, which is around $61 as of this morning, this entails a 6% discount. And again, this is effectively the price you would be willing to pay in order to have certainty in your revenues. Okay. Now, this is going to be quite interesting, and it ties back to your initial question around the implied Bitcoin price, Jarrett. One fascinating thing about forwards markets is that it embeds information around forward-looking expectations from market participants. This is a very important and central message for us to understand, because what it means is if you're just looking at spot hash price markets, you're not taking into account the full spectrum of information that's being baked in to the market. This is why the forward market matters, because it gives you more insight and more information, not just on current conditions, but what market participants are expecting to happen in the near future as well. And this is one example to demonstrate this fact. So what we're looking here is the trading session for the month of October 2024 in both our US and Bitcoin denominated hash rate forward contracts. What's cool is if I divide my US dollar hash price by my Bitcoin denominated hash price, I can get a Bitcoin price. And essentially what this picture shows is how investors and market participants expected Bitcoin price to evolve throughout the month of October 2024. So let's take an example. On November 4, at the very top, we see here, March 2025 implied Bitcoin price was the sell at the very bottom right, $72,034. Conversely, in the 30th of September, in the beginning of October 2024, this was around 63,700. So what we've seen is that throughout the month of October, as trading took place, as October 2024 took place, as we saw what Bitcoin price action looked like, expectations around Bitcoin prices changed. It increased by 13%. However, if I were to do the same with our hash price tables, we would actually see the exact opposite, which basically means that forward markets expected Bitcoin price to rise in the near future, but they didn't necessarily think that this would reflect on hash price. So Bitcoin price expectations rose, but not enough to offset growing hash rate expectations, which again ties back to our point around it's not just about Bitcoin price, but it's about hash price. It's about taking into account network difficulty and transaction fees in addition to Bitcoin price to understand what mining economics will look like in the future.
Yeah, this is one of the also really fascinating images that's part of this episode. And one of the things, for everyone here, a little behind the scenes, Kaan and I have been discussing collaborating, right? We first got on a call maybe 2.5 months ago, and we were like, what can we do? What is the value we think we can bring to the mining industry? How can we get people's attention, right? People's attention is relative to their time, which is their most valuable resource. And we were talking about the future and we were talking about the presence. We were talking about the spot and then maybe, the future or the hash rate contract. And here we are today. We're giving this, we're presenting this. And the highest number we have here for the spot is $22,000, like math. Yeah, no, it's less. It's almost $30,000 off what the actual spot price is today. So in some sense, Bitcoin is moving so fast right now. And we had a God candle. I think a God candle is typically described as $10,000 in a day. I think it got to about 9,000, but at that time it was 10% increase in one day. And so things are just kind of going crazy with Bitcoin. And I'm very interested now for the next episode to see how this image specifically may start to change. I don't think I always felt like we were going to be 100K by 2025, but I didn't foresee those one or two crazy days we had like last week or the week before, where it just kind of went parabolic. I'm very interested to see. But this does answer my question. I said, hey, Kaan, how do we get to $150 hash price? What does the Bitcoin price have to be? And you're saying even if the Bitcoin price is, let's say, 200,000, that doesn't mean that the hash price is also going to continue to feel that bullish, because ideally more hash is coming online, which is driving up the difficulty. And we also need to take into account people's power and their power contracts, right? Which is goes back to the original cost curve that you kind of showed. So anyways, I love this image and thank you for putting this together. And this provides a lot of context, I think, for people watching and trying to maybe make draw the lines right between the points of what is the spot price of BTC and what is potentially going to be the hash price.
Absolutely. And our derivatives desk produces a monthly report exactly on this analysis every month. So if anyone is interested in keeping up to date with that, definitely find our blog post around our monthly look back series, and you'll be able to see how these expectations evolve over time. So yeah, looking forward to the next one. I think it's going to be quite interesting to observe. So now, again, tying back to your point, Jarrett, if we now make an assumption around transaction fees, we can do the same calculation for difficulty and network hash rate expectations in the forward markets. What do forward market participants think hash rate is going to look like at certain points in the future? So very simply, what we can see here is a year-end hash rate expectation of around 750 exahash. And as we moved throughout October's trading session, this increased by over 100 exahash. So we started the month of October with investors expecting a year-end hash rate of around 640 exahash. By the end of the month, they thought, no, it's going to be much higher. It's going to be around 750. Same thing with difficulty. We can see a year-end difficulty of around 104.6 trillion. Now, keep in mind, we're quite close to these numbers as of November, right? We talked about difficulty at the very beginning. We're around 102. And in terms of hash rate, we're around 735, 36, something around that range. So what the forward markets are expressing is that there's a significant increase in expected hash rate over the coming months, which might be bullish or bearish depending on what your mining operation looks like. So that brings us to the end of this first episode. Hopefully this was valuable. We'll now open it up to some Q&A.
So I've been monitoring the questions, and we've had a question about, is anyone mining Caspa? I do not know. People are mining Caspa. I just want to show this and make sure we give shout outs to all the questions we get. Is anyone mining Caspa? At Compass, we're not mining Caspa, but others, Luxor, I'm not sure. I'm not sure if you guys are. I don't know if you, yeah. Okay. So yeah, this is a pretty Bitcoin only place. But there's all types of hash out there. So I've been monitoring the questions. Colby's question was probably the biggest one. We've gotten a lot of love, informative episode. We've got some other fire emojis. Cameron, who's on our people team, hopped up and said, great stuff, guys. I also want to just say, if we're doing a curve of what we're doing here, we started with about 50 to 100, which is normal when you go on a live. And now we're up to around 650. So I think by December, ideally for our next episode, we'll be cracking that 1K. One of the things I wanted to just call out was looking at looking at the numbers. I have some information here on a chart. So from 2010 to 2024, the percent change average in December has roughly been about 12% for Bitcoin. And in a halving year, it's even more. So I do think that we're going to, by the time we come back on in December, and I'm going to shout that date out in a second, I do think we're going to probably see over 100K Bitcoin, not financial advice. And I'm interested to then see how that affects the hash rate that comes online, which will affect the difficulty, as you've looked at, which will obviously then affect the hash rate, which we just looked at, and then will affect the hash price, which is really the thing miners are looking at most of the time if they have to look at a metric, just because it's a pretty encompassing metric. So I want to shout out right now if there's not any. Ooh, looks like we may have a comment here. Um, nope, nothing. It was just another nice little compliment. Next time we meet here, Kaan, you and I, to do the mining metrics, the second episode, which I'm very bullish about, will be on December 18th. So we're going to be here every third Wednesday. So that's going to be December 18th, and that will be at noon Eastern time. And I believe Toronto's in Eastern, right?
Correct. Yes.
Okay, perfectly. So you and I are almost always in Eastern. We've chosen this time because it's right around lunchtime on the East Coast. It's right around the morning if you're in the Pacific. Maybe you're getting into the office and you can throw this on in the background. And for those in Europe, it is towards the end of the day. You're in transition, you're riding the train home. Maybe you're already home. Maybe you work from home and you're just wanting to check out and hear some Bitcoin mining stuff. So hopefully this time works. Please reach out to either Con or myself, or you can leave a note on Compass's socials or Luxor socials if you think there's a better time. We're obviously open to making sure that this meets people where they want to be met. And so we've chosen this time, but please reach out if you think it's not the best time. We don't have any other questions, which is either a really good thing or a really bad thing. Either it was so crystal clear and they have no questions, or maybe they just don't have any questions. Kaan, anything from you before maybe we kind of end this early?
Thanks so much. Yeah, super fun session. Great to be with you, Jarrett. Hopefully, our audience found this valuable. If you want to reach out to Luxor, find us at luxor.tech. Feel free to check out our hash rate index blog post as well. We read and write about Bitcoin mining all day, every day. So, yeah, looking forward to it.
Yeah, and if you're watching this stream, it's through a Compass Mining channel. It's either on YouTube, LinkedIn, or X. So please go ahead and subscribe to those. And we will be back, as I said, on December 18th at noon Eastern. And if you want to make sure you get a reminder, this just kind of pushes out to X. But I do know if you're on our YouTube, you can hit the notify me. And if you're watching this on LinkedIn, there will be, and I'll be launching that probably tomorrow, there will be a live event created. So you can go ahead, find it on our page under our lives and say, hey, you know what? I want to go to that. So that way you get those reminders. And the other thing, as I said at the beginning of the show, is we are going to take this, we're going to package it up, and we're going to put this up on YouTube so this lives. And it's going to be interesting, honestly, in March or April, May, once we're 6-7 months out, to kind of look back and say, wow, that's where we were with difficulty. That's where we were with hash price. That's where we were with hash rate. And that's where we were with the BTC price. And that's where, let's look at the ASICs again, right? So it's going to be interesting. But anyways, Kaan, I want to thank you for joining me. I think this was a pretty good start to the Mining Metrics show. And thank you for everyone watching. And we will see you on December 18th, which is the third Wednesday of December at 12 p.m. Eastern time.
Thanks so much. Take care.
Bye, guys.